Hi, Warriors. Who's ready for the PPI today? James, how are you? Bran? Oh, thank you. AJ, Glenn, how are you? K-Man, Michael, Patrick, Bran. Hi, Sinatra. Okay, check this out, guys. So, Putin is threatening nuclear war every other day. Germany's parliament rejects a call to send missiles to Ukraine. Short memories. I mean, Ukraine was their ally in World War II. Okay, anyway, um, you know, fear like we have to conquer every day in the markets, right? Afraid of those algos that are going to get us. Anyway, let's start with U.S. dollar yen. Hit 48. Ryan, coming off here. You think this is it? Or could we get another push? Because I actually think if we start penetrating 48, 49 is in the cards. How about you, my trading warrior brother?
Yeah, right. Hi, Dale. Hello, everybody.
Oh,
Right.
yeah, Ryan, your voice changed.
Yeah, he won't be with us today. He's
You
off.
know, what happened to your accent? You sound more, I don't know, Dutch or something?
No,
British?
stop. Please, everybody, stop comparing my accent with a Dutch accent. It is not, okay?
Okay, what is it?
I'm Belgian. I'm not Dutch.
Oh, okay. Okay.
Anyway, um, yeah,
Hey,
it's
people accuse me of being a New Yorker, so I know how you feel.
yeah. I mean, it's painful.
I know.
It's a
All
real
right.
pain. My chest pains are coming back now, Dale.
Oh, well, okay. Pain.
Yeah,
Welcome to the club, the Pain Club.
yen is very much a mixed picture right now. We've had those confirmation of good wages. We've got Ringo tomorrow. In the meantime, if you look at dollar yen has been capped around 148. I think that's got to do with overall the dollar being a bit on the defensive as well, and people don't need to really sell yen either because the door for March has been left open by quite a few commentators and expectations for March are real. So it's going to be, I reckon, a case of rather trading ranges. But what we've seen as well is that, and those are last week's data. The Japanese foreign bond buying numbers came out, and they are still quite positive. That means that Japan is still putting its money to work elsewhere in the advent of the Bank of Japan. So that is keeping the yen from really strengthening too much. And I really think it's a range for now in
Is this
everything
the
we are
top
doing
of
now.
the range? Came in 48, or where's the top? Would you sell it here?
Well, that'll depend on the US data.
Okay.
But no, you know what? I'm not going to sell dollar yen, but I would sell another dollar if the data are good, and dollar yen will probably be no exception. But I mean, well, I mean, it's going to depend on the speed. If they do something in March, really do something in March, the yen is likely going to strengthen. But imagine that they don't, we could be trading 150 again in the dollar yen, you know?
Yeah, I doubt it. We have yields at pretty important levels here. That 420 level was significant. So is this just a retracement before another leg down in
Mm.
yields? Again, we could say we have to
Yeah,
wait for the reports.
we've got 2 days of pretty important data now. Starting in half an hour, we got the retail sales, the PPI. Then we've got tomorrow as well, and then apparently there's some expectations perhaps on models going to model PCE or so, but. And then tomorrow we have another slew with IP and the Michigan and a lot of stuff. So I think it's decision time perhaps for that 420 on the 10s, and also even the 2 years. You know, we are back trading at 462.63 where the dots are. for the Fed, and it's Fed time next week. So it's going to it should move as well on the yields as on other instruments in today and tomorrow's session.
Okay. TLT, I'm still looking for 90 wrong and reverse out longs over 96. Uh, I think this is still the most important chart on the board right here. Metals continue their run. I guess yields are trumped by threats of nuclear war until today. So, I think we're close to where we're going to get this correction. We could have another rally, but got to be a buyer on breaks back here. If offered, can silver do better? Trade 25.5 or so, maybe. But I think I'm going to have a chance to buy it here.
Mm.
So
Yeah, I think Stelios has his level right on the 25 bucks line. Mine comes in a bit higher, but perhaps
the weekly
um,
trend line, right?
yeah, I've got two actually.
Hello,
They
I
both
can show
converge
Yeah.
to the 25 and a half around. Good
Uh,
morning, Stel. Good afternoon.
I
okay,
can
go
show
ahead.
you if you want.
Take it.
Hello. By the way, I do agree, Dale. TLT yields are the most important thing at the moment. Let me take the screen. Desktop one. Here
That
we
was a
go.
pretty good call on the TLT when everyone was looking for a breakout on Monday.
Yep,
Wasn't it Monday?
it was.
So,
Yep.
it's still a flag, but it could, yeah. So I like that chart.
So
Nice.
look at that. It stopped. Well, it's still there, but
Yeah.
this is a very important level, 25, 25, 10. And then really it's all about 26, 26. What is it?
Yeah.
26,
That was
10,
a
something like that.
spike. Yeah.
So, and you know what? I don't think that metals are rallying on the back of nuclear threats or fears and all that. I think we can all agree that not in the very short term, but more in the medium term, metals are an inflation hedge, especially gold. The problem and the perverse reaction that we almost always see is, oh, we have high inflation. That means that the Fed's going to be tightening. That means everything is going to be going higher in price because of inflation, except metals because they have to go lower. I mean, that's the ridiculous thing that happens, but that's the reaction we always see in the short term. So tighter conditions, metals go lower. I think now markets are kind of realizing and accepting that if everything's going higher due to inflation, and man, do we have inflation? I'm not talking about the 3% or 3.5%. I'm talking about the uh, $2 trillion deficit every year that needs to somehow be funded by the US, by more by the UK, more by the Eurozone, everything. So inflation in terms of monetary inflation is here, and I see absolutely no hope of this reducing. So
Okay.
even if CPI goes down to 2% or below, the rate of change of money supply is going to be going higher. And yes, everybody's saying, "Oh my God, M2." Actually, let's have a look at that. There we go.
That silver chart that you had there,
Yep.
Stel, it measures on a breakout to about $40 because you had that COVID low rallied $18.
Yep.
So $18 over a breakout gives you, I don't know, $42, $43 silver. It's a
Well,
hell of a move.
the first big level is going to be 30, which is the previous highs. But we have a long way to go. But
I'm
look at
just
this.
showing that. I'm just saying breakout from that spike low
Yeah.
was an $18 move. So you break
Yeah.
out, you could just add it on.
That makes a lot of sense. And we talk about money supply, we talk about macro. Everybody saying, "Oh my God, money supply is contracting for the first time since World War II or whenever it was." And then you look at the chart and you say, "Yeah, okay, this is this is a blip, an
What a
absolute blip."
contraction.
Yeah. And
Yeah.
every time we got a little bit of a contraction or tight conditions, the markets start going a bit haywire, and the Fed knows this. As I said before yesterday, I said that look, there are really very few reasons for the Fed to be cutting at the moment. Inflation is still well above 3%. Unemployment, yes, okay, ticked up 0.2 last time, and maybe the inner workings of unemployment and the details are not looking good, but the headline number is still good. So why should they be cutting? I think that if they do start cutting, as the markets expect, maybe it's going to be for two reasons. There's some kind of a market reaction which is not good. Equity start dropping fast, which they're not. Or B, they know something about maybe commercial real estate or regional banks that we don't. So at the moment there is no reason for them to be cutting. But this is the Fed. They've surprised us many times in the past. I don't think they're going to. It's beyond the realm of possibility that they surprise us again. And look at we're talking about gold and silver. I mean, I've talked about this for months. This consolidation here was immense, was fantastic because of all the tightening that was happening. And even though there was all the tightening, gold was steady as a rock. So I was saying the breakout's a matter of time, and it has come. Now the question is what happens next. If I knew, I'd be a billionaire. But anyway, stocks are just on a world of their own. I see no reason. I said this yesterday. I'm going to say it again. No technical reason to be going against this. It's just a straight line. I think the path of least resistance remains to the upside, and that's because you hear everywhere, "Oh my God, I'm shorting this. Hedge funds are shorting." It's at the moment positioning, sentiment, all that. It's I seriously would not short this.
Well, and hey, good morning, Stelios.
Hello.
Hey, it's first of all, I want to say it's really nice to hear your voice. I know you checked in this week because I was going to be out and it's really nice to have you here. And this is something I wanted to ask you, and you're bringing up a great point regarding the stock market. Something that we go back to like last year, and you talk about positioning. Think about all of the macro analysts, all of them, how wrong they got the market last year. All of them. I don't want to just start rattling off names, but a lot of them you see on CNBC, Bloomberg, YouTube. They're sensations on, YouTube talking a great macro game. And even though they were all bearish last year, you have everybody that's really FOMOing it and chasing this year. Because imagine all the institutions that subscribe to their, wonderful macro analysis, just talking about how bearish things are going to be, and everybody's just stuck chasing this year. And as you reach for new highs, and then everybody looks around and goes, well, here, we're still not in a recession. Maybe we're never going to go in a recession. Everybody's forced to chase returns higher, and that's been the problem with the very first couple months of this year.
Yeah, I think these guys eventually are going to be right, but if you're wrong by a year and a half, and you're right on the outcome, you're basically wrong. But what I think is going to happen is there's going to be some serious FOMO in the S&P between 52 and 5,400, and that's when I think everybody's going to get bullish. That's it. No recession, no downturn ever, because hey, inflation is taking everything higher, which is correct on a 30-year time frame, right? So I think there's going to be some serious FOMO. Already you're getting FOMO. I think it's going to be some more, and then I hate to say it, but anywhere between 54 and 5,500, I think that's the place where theoretically we should be starting to look for lower levels. But first, the sentiment and the analysts, they all have to change to being really bullish.
So a moment ago, you talked about the money supply and and how it's just it's exploded. Obviously, then here we got rates moving higher, and again, I'm going to go back to you. I haven't had a conversation with you on the F.A.C.E show for quite some time. Rates have been going higher. Yields have been moving higher globally. How are governments going to continue to service this, these debts?
How have they been doing it for decades now? Just issue more.
Yeah. Okay.
That's what they're going to do.
But everybody thought that, when we came off the zero bound, globally, that's going to be the death knell of all central banks. But, they've been managing thus far. So what now?
Well, for me, the thing that would change my mind if it would be if I start seeing the US and the UK and Japan having surpluses. That's when things will change, and that's when they have options. At the moment, they have no options. They, 1.5, 2 trillion hole every year. What do? You have to borrow. I mean, there's no other way. And if the market will not be good enough rates wise for you to borrow, you will have to buy some yourself. The Fed will have to monetize more and more. I don't see any other way out. Do you see any other way out? I really don't.
I don't. No, I don't. I mean, but right now the take up and all the auctions seem to be fairly strong. I mean, overall.
Yes.
When does that stop?
When yields are not as attractive. So I think when we go back to 10-year being at 2.5%, then I think the Fed's going to start buying more themselves. Because when we were talking about yields, what was it, 6 months ago,
Yeah.
9 months ago, and I was saying, look, I speak to a lot of friends of mine who are very wealthy, and they're all saying, oh, 5% and above in 5% 10-year US, I'm going to buy loads. As we get down to 4% and we're going to get lower, then that gets less and less attractive, especially given that inflation is eroding purchasing power and everything else gets more expensive. So the incentive to be holding bonds becomes very low. And I hadn't been long bonds in years and years because the yields were ridiculous, and to get any kind of decent yield, you have to take a lot of risk. So my view is I think yields are going to be going lower. Maybe we rally in 10-year towards that 430 level, which has proven to be 435 has been a very strong resistance. Maybe we rally up there on some good numbers, maybe. But I think the way this resolves is to the downside, and it seems like some kind of bearish flag, doesn't it, at the moment?
It does. Yeah, it does. That's interesting. Hey, I wanted to ask you guys a few questions. And by the way, I'm still getting all my charts are, I got in kind of late last night, so I'm still kind of getting my bearings straight on everything. But you can continue to show whatever charts you want to, and then I'll help prepare everybody for today's data that's coming out.
Yep. So currency wise, I said the other day, I said, look, if there's the inflation number is strong by a little bit, not a big beat, I think dollar rally should be sold. And the Dixie has done nothing really. It's been very flat. My favorite dollar short remains dollar MEX. Look at this level. We're really, really close to that now, 1660. Well, there basically. So expect a bounce. Maybe the numbers today, if they're a little bit strong, we should be bouncing, but I would be looking to sell into rallies. Remember, there's very good carry on this, over 5%, if I'm not mistaken, or 5% or so. And interestingly, we got the inflation data for Norway and for Sweden. Sweden, I think, was today. Norway was yesterday. And they are both below expectations and seem to be on a downtrend. So I think this is a global phenomenon. And yes, the US inflation number was a little bit higher than expected, 0.1. But in the grand scheme of things, I think inflation is going to be grinding lower. Will we get to 2%? Yeah, maybe eventually. But I think we have to get used to an environment where inflation is above 2% for a while. And I think,
but we continue to see this I won't call it US exceptionalism, because we'll see how exceptional the retail sales are today, if they are at all. But we are seeing inflation stickier here in the US than in a lot of other places, right?
Yes, compared to the Eurozone, let's say, yes. But if I'm not mistaken, the UK inflation is higher, isn't it? But anyway, it's all on a downtrend. That's the main thing. And yes, it's a slow downtrend, but I think it's intact. And central banks, as long as this is the case, they're going to be a little bit more, how should I say, it's going to be a little bit easier for them to be talking about rate cuts and all that. Now, the question is, when they start delivering the rate cuts, how does inflation respond? Because cuts are theoretically, with a lag, they are inflationary. So today we had the ECB's Tournaris, the nice Greek guy, who was saying, if I'm not mistaken, that they need to do 2 cuts before the summer, which is pretty punchy. The euro is not really responding to that. It's in no man's land. You know, the dollar at the moment as an index is still in no man's land. It's still kind of chopping sideways for the last year or so. I still think this will get resolved to the downside. But at the moment, it's looking relatively stable. The thing to watch is how does the dollar react on strong numbers? That's really what we need to be watching. And the CPI reaction was to be sold into the rally after the strong numbers. So we wait
Yeah.
today to see what happens.
Yeah, matter of fact, do you mind if I take over the charts here?
Yeah, go for it.
Hey, thanks, Stel. And you know, and Dale, good to hear your voice, man.
Hey, Blake.
Hey,
How you doing?
I'm sober.
Tired?
So that's day drinking stopped a couple of days ago. So that was fun.
Yeah.
There's nothing like being in Mexico and just you know, just drinking cervezas all day long.
Where
on the
were you
beach.
in Mexico?
I was in Rocky Point, which is
okay.
it's the destination of it's Arizona's beach
Yeah.
city, really.
You drive there.
Yeah. It
Yeah.
it only takes like less than 4 hours, so
Cool.
it's an easy drive. And K-Man, thanks for holding down the fort. I guess Ryan's at he's at a footy match, right?
Yeah, he is. Yeah. Hi, Blake.
Oh.
Back.
Man, all right. Well, I'm sure he'll be doing his fair share of beer drinking. So let's talk about real quick CPI reaction on Tuesday.
Yeah.
So CPI came in a little hotter than expected, right? I mean, you're looking at the data and it came in, you know.
People like to look at the secondary data now. Seems like the headlines are not. But in fact, that thing has been going on since virtually. Okay, we had different moves year-end and stuff. But virtually since the labor report that we had in November last year, that's when this sell dollar rallies on better data has actually started, even though we had different moves. But it's still been the case. Because I think they underpin equity markets and things, and then you have like those little correlations coming in with it as well. But yeah, it's been the case. But you know, I said it. When was it? Like about week or two ago. I said we had the big dollar dump into year end. Then we had a recovery. We went to around 50% or so of the recovery, and now perhaps it's more sideways. So that's where we are. Unfortunately for us, the FX vols are getting sold ever more depressed, especially in the euro. It's really not good. We are, if you look at the 1 month, we're at 5% now. This is starting to be a bit low. So
this is real low, yeah.
Yeah, so we need a bit of a catalyzer here to make things start to move again. Really, it could be the next 2 days because there's a lot of data coming out. So we are always hopeful that things will start to move finally again. But I think there's more interesting stuff than the euro dollar, especially the markets. If you look at the euro dollar, there's so much volume in there, and then with suppressed FX option volatility, it's a big beast to move, right? So I would say if you want to trade dollars, it's perhaps better to look at stuff like cable, Aussie, Kiwi, things like that.
Well, let's just real quick, just so everybody has a decent view of what's happening in the euro. You know, this is I'm just looking at my charts from where they were at, you know, before I left. And now it looks like we're consolidating in an ascending channel right into the 618 retracement, completed an equal leg move, now consolidating in a triangle. And you can see that this is Tuesday's move. We went right below, like just below that support zone, bounce back up, resistance zone right at the top here. So we're really just kind of, you know, between 109 and 110. And I think that's gonna, you know, a move out of that 109, 110 level is maybe what's going to do it. And then even if we breach 109, we have channel support that's right below it. So just this is, you're right. I think that it's going to be a little tricky around here now. And if you turn your attention to the yen, you could argue that we got a bit of a flag going, but at the same time, we have wage negotiations happening in Japan, and we're expecting some results tonight, correct?
We should have the Ringo first results from Ringo out tonight. In the meantime, we've had very positive news from most of the companies, right? All the car makers, they're paying up, airlines paying up, you name it. They're all paying up. Some of the big companies have not even negotiated the demands, they just gave it. So that's very, very positive. But when we had the news, like yesterday, the market did not really react to it anymore, because now we are obviously waiting for what the Bank of Japan effectively is going to do next week.
Yeah. So and the Rengo, correct me if I'm wrong, is the largest union in Japan.
Yeah, that's the largest over there.
Okay, so those negotiations that'll happen tonight in Asia, or today, tomorrow in Asia.
Yeah, the results should come out. Well, this is the first leg of 2 or 3 results coming out from there. But yeah, we should have a pretty good idea. So I guess there will be a bit of moves in the yen as well. But if you look at what's happening on the yen process, they are putting in a bit of a comeback as well, and that's still the case in the yen. It's hard to be long yen for longer because you have not had the Bank of Japan yet. So those things will need to be monitored. And in the meantime, Japan is still putting its money to work elsewhere, as I've said before. Before Bank of Japan really gives them better interest rates to buy JGBs with.
Yeah, okay. And then so if we get some weaker data, like coming out in just a few minutes, we get some weaker data. Dollar yen, you might be able to lean into it for the next 24 hours, especially coming out of the, with this the Rengo negotiations coming out. Maybe that might play into a move lower. Flip side is, on strong data, perhaps the euro is pushing back towards 109. We'll see what the reaction function is right around here. I think 109 is going to be pretty key on the way back down if the data is strong. Now remember, we do have producer prices. We also have retail sales. Again, it's hard to bet against the U.S. consumer, in my opinion, and I still think that is going to be the case. Now, stocks just marching higher. We're almost, well, I guess we did complete the 127% extension of this. And by the way, this is a multi-year 127% extension. Just so you guys know, you can see it's the 2022 highs to 2022 lows. We basically hit the 127% extension. We finished the bull flag pattern from a couple of weeks back when we were holding this 50-50. This is the bull bear line in the sand that we've talked about. While we're above it, you stay bullish. We've been discussing that for the last couple of weeks. We've completed all the patterns, but the market doesn't look like it's ready to succumb to any pressure. This week, I mean, all we've been doing is just grinding higher all week. There's even on the CPI data on the move lower right here, we just rip right to new highs. So anyway, Stelios, going into today, what are your thoughts going into the data here?
Well, I don't want to make a prediction on data, but I just think that stocks will keep going higher. I mean, they keep taking every level after the other, one after the other. We get small dips. But as I said to a couple of friends this morning, if I was short or a bear on equities, I'll be really annoyed because they just can't get any kind of reaction to the downside. So what will these numbers do? If they're weak, man, we just keep going higher. If they're strong, maybe there's a little dip, it gets bought, we keep going higher. Unfortunately, that's how it is at the moment, in my opinion. It could be wrong, but that's what I've been saying for a while, and that's what it's been happening. So good luck.
We're about 30 seconds out. K-Man, any last minute thoughts here?
Yeah, weak data, I think, on the currencies, cable, Aussie, Kiwi, probably among the better, or metals. Strong.
Or the MEX. The MEX is at huge
And
support,
it
right?
makes and strong data. Yeah, perhaps euro dollar or dollar Swiss going through.
All right. And we have data coming out in just about 10 seconds. Dale, any final thoughts here?
Yeah, react to the number rather than trying to predict it. I think the
Oh,
dollar
strong.
has.
Is that strong?
That's strong
Okay.
claims.
Yep. So good.
Yields are moving higher.
Yeah.
Retail
Goes
sales
over
came in a
420.
little light, actually. Little light on the retail sales. Producer price is strong, though. So that is keeping the dollar firm, firm, firm. And look at this euro. You know, we just went down to the triangle support, by the way. If you
Gonna
look at the
break
euro, it just hit triangle support. Now, whether we break or not,
Yeah, we
we'll
will.
see. Dollar yen right into triangle resistance.
Wow, look
So-
at that reaction from stocks, which is no reaction.
well, I wasn't around on Tuesday, but I'm assuming is the same thing
Coming
post
up.
CPI, right? You got a little bit of stock market weakness following the hot data, so we're seeing that weak stock reaction following the data.
Also,
But
NAS never made a new high with the S&Ps. They led on the way up, and they faltered first. So, there were some
and
messages.
look, we completed that flag pattern finally. I guess this week too in the Nasdaq 100. So. I mean, you're right. NASDAQ's not following, but I don't know if I'd necessarily want to chase the stock market lower because we got it again. If you look at Tuesday's reaction, we got a move lower. And then by the time stocks open, it looks like we recovered right after that and went to new highs. So I guess, bears are going to be a little nervous trying to chase this market lower again.
What bears?
Well, yeah, let's see if some of them
They're
emerge.
gone.
Yeah,
They're
they
gone.
are. I want to say, guys, thanks for the coverage while I was gone. I really wish I was still sitting on the beach in Mexico right now, but I'm not. It's nice to be back with you guys. Here, Stelios, it's great to hear your voice. K-Man, thanks for covering. For Ryan, because I know Ryan just stepped out after the Flow show today, and Dale. It's always nice to have you here. So I know you have an interview with Jamie. So have a great interview, and thanks everybody for joining us. We'll see you about 45 minutes on the Morning Edge.
Thanks,
everybody.
Okay, Stel, K-Man, Blake, team, dream team. Nice coverage. Jamie, welcome back.
Dale, good morning. Can you hear me okay?
Oh, yeah, hear you, see you.
How are you?
What's your reaction to the number?
Well, I have to confess, my screen's froze at about 8:29, so I'm only just seeing them now. It looks like PPI slightly hotter than expected and retail sales a bit weaker than expected. Is that fair?
Yeah. So the book, it kind of like a bookend, but from what we had Tuesday to what we had here. So with
Well,
that
it looks
in
like
mind, go ahead.
if PPI is slightly on the hotter side, that's the third inflation reading in the last few weeks that's coming on the hot side. We had January CPI, we had the February CPI slightly hotter, and now this. So if that's telling you something, I think it's that inflationary pressures are still there. They're not coming down, not easing as much as people had hoped for. Certainly those in Washington. And we've got a few weeks ago we had calls from the guys at Apollo saying, I think they were the first ones to say no rate cuts this year. These were the first ones to come out with an official.
Saw that.
Made a few headlines, rightly so, because it's a bold call. But the more numbers you get like this, then the more you can see where they're coming from.
Yeah, have dot plots moved after this number?
Well, this is it, isn't it? That's what everyone's going to be looking at next week. It's the dot plots.
Yeah.
I think I'm right in saying the December dot plots still pointed towards 325 bit rate cuts this year. And that's where the market's obviously gravitated to, because when we had the December SEP, I think markets were discounting 150, 160 basis points of easing this year. So they were much more aggressive than the Fed. Markets come right back into line. So I think it's all eyes on whether or not the Fed sticks with that dot plot sort of forecast. You have to say, you know, I mean, we had Powell last week saying we're not far from cuts. I think that was his quote, not far. But as we've just been discussing, the more inflation prints you get that are slightly or any way above
So
forecast, that's going
instead
to
of
change your
seeing,
thinking.
yeah, instead of seeing the light at the end of the tunnel, he's looking at a train running down the tracks.
Yes,
So he's
I
going to
think
have to. So Jekyll and Hyde, he'll be Mr. Hyde next week.
well, you know, to be fair to him, he can, and he has done, and all Fed chairmen do, or you know, chairpersons. They've got flexibility in their guidance and their rhetoric, and I'm sure that if he wants to employ, you know, he wants to give themselves that bit more leeway in terms of the statement and the press conference. I'm sure he can do that, and you know, that's within their gift.
So
to buy
10-year
themselves time.
yield over this 420 level here, Jamie, you see it? So 420 was been a very important technical pivot on the way up, on the way down, and here we are back above 420.
Yeah.
You know, and what we didn't accomplish, maybe we're going to accomplish now, and that would be perhaps a bigger retrace of this decline in yields, because we didn't even get to halfway back here, which was 439.
That's exactly right. I had one of your colleagues say in the chat just past there that he thinks yields are going to grind lower. Now we're talking about inflationary pressures maybe re-accelerating, and yet I think it's not a bad call at all to think that yields can go lower here, because we've seen from one of your other colleagues, he mentioned that the options have been absorbed pretty well by the market. I think it was $117 billion this week. It was $169 billion a couple of weeks ago. So we're at yields of, as you say, 420, 430, and yet the market is hoovering that up. No questions asked. And bond market volatility, I was just looking this morning before I came on, the MOVE index, low since September. So that tells you that the bond market is not in a panicky mode at all right now.
Would it be if we go to
issuance or data? The market seems pretty comfortable about where we are.
Okay, it may move up a little bit if we retrace back down towards a 90 level and take out the Fed lows. You know, a lot of people calling this a bullish formation, and I agree.
What's your range then on the 10-year yield? What range are you looking at?
Well, this is TLT, so it's more like a long bond, the longer end of the market, which, you know, has been underperforming 10-year. But when you look at the 10-year again, if we can maintain a close over 421, you know, why can't we make a run towards 440? That would surprise the market.
440, yeah. But where were we 6 months ago? Probably about 440.
You mean 6 months ago we were at 5.
5. Well, there you go. So there's a lot of room to go back. I think, as your colleague said, I think once we get closer, maybe 450 and up towards the 5% level, I think demand and appetite for, you know, safe, you know, quote unquote, safe assets, safe returns of 5%, guaranteed coupon payments, etc. I think the market is showing
Why don't you think this is safe?
Good demand for it.
Isn't this a safe investment? It's like a bond, isn't it?
What's that, Charles? Sorry.
NVIDIA. Why are you laughing? It's safe.
Well, we had
it only goes up, right? Huh?
Well, it went up, but there was one day last week it came down. What about a peak to trough of about 10-12%?
Yeah. The nice little key reversal. So you think that there might be some type of shakeout in the stock market, a little risk off coming in that will increase the appetite for bonds?
Again, as you were discussing in the last half hour, it's hard to see where the shakeout comes from in stocks. Okay, it's the market's very concentrated. There's certainly that FOMO, fear pervading the market, and as you saw there, we had NVIDIA wobble last week or a few days ago, and it's whooshed straight back up again. We're at new highs, and there doesn't seem to be much out there, whether it be data or policy, or as you were talking about, threat of nuclear war. Nothing seems to be shaking.
Nothing, because it's different this time.
Well, that's
Isn't
for
it?
ages, that discussion. I mean, obviously there's going to be a correction, there's going to be a shakeout at some point. But is it going to be that crash, that big shakeout? I mean, even if we get a shakeout of 20,
10%.
15, 20, 10%,
Yeah.
that takes us back to where we were when? January?
Yeah, that's what I mean.
So that's
What do you think the message is in gold, Jamie? And does Paul look at the price of gold? Does it mean anything to him?
I don't know the guy personally, but I would suspect it doesn't mean that much to him.
Okay.
And
How about to
gold
you?
is gold's a funny one, isn't it? Because perhaps I've missed something here, but we've got gold, we've got Bitcoin rallying together, surging to all-time highs. Now, I get the inflation hedge element of that, of course. Gold, you go back thousands of years for that. But Bitcoin is seen by its proponents as a good inflation hedge as well. So I get that. But one's ultra safe. One asset is ultra safe, or it's meant to be. And the other one is, well, let's just say Bitcoin's not seen as an ultra safe asset. It's highly speculative. So I'm just not quite, I think there's something I'm not quite seeing why both of them are sort of rallying in tandem.
How about this? How about this? Stocks higher, Bitcoin higher,
Everything's
gold
higher.
exploding. Financial conditions are still too easy. Dollar weakening. Isn't that the theme running through the whole market?
That could be the
despite higher
thread that
rates,
ties it all together. Financial conditions, yes.
Yeah. So
that could be it. Yeah.
Okay.
I mean, we had the Goldman, I think, the Goldman Sachs Financial Conditions Index. I know there are others out there, but the Goldman Sachs one is still. I think I haven't seen it for a few days, but it's pretty low. I think it was the lowest since September or something last year, October last year. So conditions have eased, but then you get into that self-fulfilling spiral, don't you? When the market goes up, financial conditions ease. When yields sort of come down a bit, financial conditions ease. And when the market sees financial conditions easing, they push assets higher. So it's a kind of self-virtuous circle in some respects. It certainly feels like that.
What do you think Paul's going to say in his presser after these numbers? He's not going to cut rates. Is he going to talk about us being closer? How's he going to take this when just at his last his testimony before Congress said that he could see a time that's not too far away for cutting rates?
It could be a message. He might have backed himself, or he might find it difficult to sort of nuance that message, or to display a consistent message.
You could have said backed himself into a corner once again. This guy spends a lot of time in the corner.
Well, there's certainly a lot of criticism being leveled at him that he backed himself into a corner late last year when they basically gave the green light to the pivot, and the market got built up on expectations of 150 basis points cuts this year. They've obviously, I mean, to be fair to them, though, they didn't say that in the F.A.C.E forecast. They were consistent with 75 basis points. So, but they let the market run away with itself a bit. That's obviously come back in the last few weeks. As you say, in his testimony, he said I think his quote was, "We're not far. We're not far from cuts."
Okay.
However, again, as we've said, when you get producer prices, consumer price inflation, hotter than expected, rent prices, rent payments aren't coming down as quickly as they hoped. Services inflation, some of their Fed's favorite measures of inflation, some of the gauges that they look at, core measures, core, if you like, they're running hotter than expected. So are we not far from cuts, or are we a bit further than we've been led to believe? That could be a messaging and communications problem for him. But he's been in the job how long now? How many years?
I don't know.
Several years. 7 years. How many press conferences has he done? Quite a few. I think that challenge, I think he'll probably meet that challenge fairly well. He'll give himself enough leeway and flexibility. And,
what do you think the purpose of his appearance on 60 Minutes was for?
well, these appearances on 60 Minutes and shows like that are for the general public, aren't they? I mean, we in the market, we parse their every word in their speeches and their remarks and their press conferences and interviews on financial television. But this 60 Minute stuff is for the wider public. I have to confess, I didn't watch it all, but you know, that's just trying to convey a message, probably to let the public know that they have the dual mandate of employment and stability. I mean, there's no doubt that inflation is still above target. We're still in a kind of cost of living crisis. Goods and groceries and everything at the stores cost more now than it did 2, 3, and certainly 4 years ago. So I suppose he's just trying to get that message across that the Fed is aware of that, he's on top of it, and that inflation.
He was trying to explain he was trying to explain higher rates, and also kind of made a statement that the Fed was going to keep their integrity and not monetizing all that fiscal stimulus is something that they're not going to do anymore.
That could be a tricky one as we go forward, as we're talking about as well. The market seems to the market seems to be absorbing all that debt coming on board. No problem so far, but as we've been saying for a long time, there might come a point where the market balks at that. My opinion is that I think when we have rates of 4 or 5%, I don't think there's any problem with demand and appetite for government debt. That might not always be the case, though. I think the Fed, I don't think we're going back to pre-2008 days where the Fed's imprint in the bond market was, you know, what, 5-10% of the bond market. I think the Fed is going to maintain a larger footprint and share of the bond market than it did previously. It's just, I don't think we're going back to pre-2008 days. So I suppose we have to get used to it in some respects.
Yeah, a lot of people have a political argument for why the Fed will cut to try and help Biden win re-election, which makes me think, not to look political, that maybe he won't cut, especially now that he has cover with higher numbers coming in, because, you know, he would be accused of just trying to help Biden if he started cutting rates.
But the flip side of that is, if they don't cut now or June, because obviously March, he said himself, March is off the table. If they don't cut in June, any rate cuts that they do want to implement will be much closer to the election, and therefore they leave themselves much more exposed to that accusation of political interference. There could be an argument to make.
That's a pearl, Jamie. That's a pearl.
Where they cut now, June and I don't know, July or August. So that's sufficiently ahead of the election so as to keep a distance between themselves and the vote. So you can argue it both ways.
Okay. Why don't we talk about another central bank, BOJ? They've been making some noises about that. You know, they may be normalizing. They may raise rates. The yen hit a pretty nice high here. It almost looks like it's possible the top is in the yen. Kind of a big double top. Are they going to do it this time, or are they going to be like they've been like Lucy in Peanuts, that when you go to kick the ball, they pick up the football and you go flying across the field? Charlie Brown.
This is a date with destiny, isn't it?
Yeah.
It'd be the first rate hike in since 2007.
God, I was only 10 years old.
There you go. You haven't aged a bit, but 2007, and it would take us out of negative interest rates, which have been in place since 2016. So that's 8 years, 7-8 years. I think people who've been trying to second guess the Bank of Japan, or trying to guess when they're going to normalize policy. It's been a long waiting game for them, hasn't it, over the years? There's certainly, I mean, there's certainly a head of steam is building up. There's no question about that. You and your colleagues were discussing the wage negotiations in Japan.
Right.
Toyota, given the biggest pay increases in 25 years, we get this survey data on wage talks tomorrow from the Labour Union, which sources have told us in Tokyo that could be what tips the balance for the Bank of Japan. If that comes in fairly positive, i.e., strong, showing that wage growth is sustainable and in place, and that could be the green light for the Bank of Japan to move in March.
Can you remember in your career, Jamie, any time period where labor has had so much leverage to garner these kind of wage increases ever?
Absolutely not. No, absolutely not. And I've only been covering this stuff for 25 years, 26 years. So we're talking about the mid to late 90s onwards. I don't think labor and workers' pay and influence in wage talks has had any impact, any bearing in that time. I mean, the 60s, 70s, and 80s perhaps, but certainly not since the mid 90s, not at all. But that's just a consequence, obviously, of the pandemic, the inflation burst that we saw, and we are where we are. It's an interesting contrast to make, though, between Japan and, say, the Eurozone. Just say, for example, that Toyota pay award of, well, actually, to be fair, we don't know the actual percentage increase, but say for argument's sake it was 5%. So the Toyota are giving the workers 5% pay rise. I think in Japan that would be seen as a kind of, that would be seen as a virtuous wage price spiral, which could force the Bank of Japan to normalise policy. However, if you get 5% wage rises in the Eurozone, oh no, got to be careful, that's a dangerous wage price spiral. So, I mean, but it's the same number.
Yeah. Oh, so basically that's not happening in Europe. So, I mean, people have gotten 20, 30, 40% pay raises here in the US.
40%?
Certain union.
I'm in the wrong job.
Yeah, I said that too. Jamie, anyway,
who's getting 40%? Who's getting 40%?
Some of the wages for the auto workers.
Auto workers.
Over the course of years. I mean, I can't ever remember a time when actors actually had any leverage with the studios. They would have to break I mean, it's everywhere. So
but yet we're seeing, I mean, we're talking about some of the CPI and PPI prints being, that much, a tiny bit higher than expected. Take a look at inflation linked bonds, tips, break-evens for 10 years, 5, 10 right out years and further out the curve. Can you see any sort of sense of panic in these markets?
Oh, they're talking about credit spreads being as tight as they've been in decades.
Yep.
No one sees any risk out there. But
we're discussing that risk, and I think people are aware of it. But is there any catalyst that's going to trigger a shift from where we are now in this kind of, I hate to use the expression, but this Goldilocks kind of world of things seem to be rolling along fairly smoothly, unemployment's still quite low, debt serviceability, is okay on a corporate level and even on a household level. People are feeling asset rich. Corporates, the big ones anyway, have a lot of cash in the bank. So is there anything that's going to trigger a shift out of that kind of scenario into something where we are much more concerned, like instantly concerned about inflation risks? And we're not seeing it in the bond market, we're not seeing it in the credit market, we're not seeing it in volatility. We're just not seeing it yet.
Yeah.
That's not to say it can happen, but right now, why would you want to go against it?
Yeah, because there are times when contrarians are right, but they could be broke before they are.
What was it?
And that's why
Keynes said the
what's
market
that?
can stay. What was it? Keynes said.
Oh yeah, the market has stayed solvent longer than me.
Or something like that. Yeah.
The market always
wins,
Mr. Market.
Yes.
Yeah.
So the market may always be right, but as one of your guests was also pointing out earlier, timing is everything.
Okay. So
And right now, it's hard to see. It's hard to see what's going to, flip that switch.
how about a chaotic election or something like that in the U.S.? There are
Absolutely.
elections all
Absolutely.
over. Yeah, and we're not that far away. It's only 7 months away. That flies by.
Absolutely. No. I think that risk, the risk of, whatever you want to call it, around the November election is certainly a factor, and that could concentrate people's minds. But 7 months away, as you say, will fly by. But there's a lot of data in between now and then. There's a lot of policy decisions, a lot of earnings. There's stuff in the here and now, well before that, which the market will probably trade off.
Does Reuters do a poll? Do they do polls on presidential polls? If so, what are they showing?
I haven't seen our last ones, but the ones I did see this week is that Biden's kind of pulling ahead 2 or 3 percentage points. I mean, it's a very small margin, and it's probably within the margin of error. But on a sort of broad base of national polls, I think it was can't remember what publication I saw it, but they aggregated some of the consistent polls over the last few weeks, and Biden's pulling ahead, but it's a very small amount, 2 or 3 percentage points.
Okay, if he gets reelected, there is going to be tax time, raising capital gain tax, raising corporate taxes, saying anyone making more than 400K.
Could be, yeah.
Could that be something that's a pretty big fundamental change? If your capital gains go to 50%, it makes speculating in the market not as not the greatest risk to take if you have to give half of it back.
I don't think the markets will like that one bit, but that could be difficult to push through both houses, of course. I mean, we have to wait and see.
Okay.
On the other hand, you can argue that if Trump gets in, he's more committed to, if you like, America first, onshoring. There could be more of a trade war. Tensions with China, and certainly in terms of trade, could ratchet up. And all else equal, you could argue that could be inflationary. So we could get inflation re-accelerating, or inflation expectations re-accelerating. So, there's arguments on both sides, certainly. But I think given the relative calm in terms of market volatility that we're seeing right now, and some of the spreads that we're talking about being the tightest in years, the election is a risk, but it's over the hill slightly. And 7 months is, down the track a bit. I think once we get closer to it, you'll start to see that filter into market pricing. But we're not seeing it now.
Well, Jamie, you're far from over the hill. Okay.
Don't feel like it.
Keep up your great work at Reuters, Jamie, and the best place for people to follow you on X at Reuters, Jamie. Do you field questions when people send you, DMs or something like that?
No, absolutely, absolutely. I'm happy to engage with anyone who wants to get in touch. I'm a bit less active on it these days than I was in years gone by. I think that probably applies to most people. But yeah, certainly. Always happy to engage.
That's pretty amazing to just be able to send Jamie a question and have a guy like him answer it. So thanks for your giving spirit and for coming here over the last few years, Jamie, and edifying our community. I hope this year is a great one for you.
It is absolutely. It's fantastic. Always happy to come on and please ask me back.
Thanks for letting me interrupt you today at least 20 times. And we just keep moving on, and really very interesting about if they're going to do it, they have to do it now to not look by June, to not look political. I think that's a pearl. That's an article.
Well, let's see what they say next week. That could be one to watch.
Okay, Jamie
Dot plots next week. Dot plots and the long run neutral rate. Those are the ones to watch.
Okay, I think they'll use some whiteout on a dot or two. I guess that's what I do.
The neutral rate could be revised higher as well, slightly higher. Yeah. Now, these things get a bit wonky. Some people dismiss the idea, the whole concept of the neutral rate or the long run R star, etc. But the policymakers do look at it, and if they do, markets probably should too. So that could be one to watch.
All right. Thanks so much, Jamie. I'll talk to you
Thank you,
in
Dale.
late spring, early
Look forward to
summer.
it. Look
All
forward to
right,
it.
buddy.
Take care. All the
Jamie
best.
McGeever, everybody, follow him. You could tell we covered a broad range of topics, and he's willing to, if you have a question about anything in the financial markets, especially what's happening with the Fed, shoot Jamie a message. And that's going to be a wrap for me and F.A.C.E. Thanks for being here, everyone. Hope we gave you an edge. Don't just count your pips, count your blessings. And join the team in 15 minutes for the morning edge. And I'll see you guys tomorrow. And that'll wrap up the week tomorrow. Yeah. Okay, cool. All right, Jamie, take it easy, buddy.
You too, Dale. All the
See
best.
everybody.
Bye-bye.
People are thanking you, Jamie.
Well, thanks to them. Thanks for watching. And I
right.
hope some of it made sense at least.
98% did.
I'll take that all day long.
All right, buddy. Thank you.
See ya. Bye-bye.